lecture, we're going to be looking at currency and interest rate risk. So first, let's start with currency risk. Now guys, currency risk is the potential for losses due to adverse movements in foreign exchange rates. So obviously, not every company will be exposed to foreign currency risk, only companies that import and export. So if you import and you buy things in foreign currency, or if you export and you sell in foreign currency, there's a risk that exchange rates might move in a certain direction, which could create losses for the company. So in this lecture, we are going to look at how companies can manage this currency risk. But before we get to that, we need to cover a few important definitions. And the first important definition is what is a direct quote. And a direct quote is when the rand is quoted relative to the foreign currency. So for example, $1 is equal to 15 Rand 20. And what's important when we're doing calculations and we are trying to calculate the rand amount, we always need to multiply the foreign currency amount by the exchange rate in order to convert it into rands. Let's look at what I mean in the example below. Everest Limited purchased a machine from the USA for $200,000. The current exchange rate is $1 is equal to 15 Rand 35. So you can see, guys, we are dealing with a direct quotation because the rand is quoted relative to the foreign currency. We are given what $1 is in rands. So if we want to convert this dollar amount into rands, we need to multiply it by the exchange rate. So we take the $200,000, we multiply it by 15 Rand 35, and we work out the rand amount. Now guys, think about it logically. Test your calculation, make sure what you've done is correct. Because the rand is weaker than the dollar, obviously the rand amount must be more than the dollar amount. So my calculation makes logical sense, therefore I know I've done the calculation correctly. On the other hand, if we have an indirect quotation, an indirect quotation means that the foreign currency is quoted relative to the rand. So now this is what it looks like. 1 rand is equal to $0.06. So now if we are trying to convert foreign currency into a rand amount, it needs to be divided by the indirect quote. Again, let's look at an example. A South African company buys goods worth 71,500 from the USA. The current exchange rate is 1 rand is equal to 0.0626. So this is an indirect quote because the foreign currency is quoted relative to the rand. We are being told what 1 rand is equal to. So if I want to take this foreign currency amount and convert it into rands, I need to divide by the exchange rate. And once again, please apply logic to see that this makes sense. We know that the US dollar is stronger than the rand, so the rand amount must be bigger than the US dollar amount. Okay, so please note, when you're dealing with a direct quote, we multiply it out so that we can get the rand amount, and when we are dealing with an indirect quote, we divide it so that we can get the rand amount. Then you need to understand what a bid or a buying rate is and what an ask or a selling rate is. And please note, when we look at both of these things, we are looking what the bank is doing. Okay, don't look at what we are doing, look at what the bank is doing. So the bid or the buying rate is the rate that the bank will buy currency at. So guys, if you have foreign currency, as a South African, if you've got dollars or if you've got pounds and you want to go and convert that into rands, you are going to sell your foreign currency to the bank, which means the bank is going to be buying the currency from you, and they will buy the currency from you at the bid rate. On the other hand, the ask or the selling rate, that is the rate that the bank will sell currency at. So for example, if you're going on holiday overseas and you need foreign currency, you are going to go to the bank with rands and you're going to ask them to convert that into foreign currency for you. So the bank is going to be selling foreign currency. You are going to be buying foreign currency. But we don't look at what you're doing. We look at what the bank is doing. The bank is selling the currency. So when the bank sells the currency to you, they will do it at their ask rate. Now, I just want to add some numbers to this so that we can do some examples and it makes a little bit more sense. I want you to assume over here that $1 is equal to 15 Rand 20. That is the bank's bid rate. And then I want you to assume that $1 is equal to 15 Rand 40, and that is the bank's ask rate. Okay, so if you have foreign currency and you want to go and sell it to the bank so that you can get rands, the bank will buy it from you at a rate of 15 Rand 20. However, if you have rands and you want to buy foreign currency, the bank will sell foreign currency to you at a rate of 15 Rand 40. So there's always a difference between the buying and the selling rates, and that is how the bank makes their profit. So that's the next point we need to understand, the bid-ask spread. That is the difference between the bank's buying and selling rates. So it is the profit that the bank makes. So with the example that I gave you guys above, if we had to work out the bid-ask spread, it's the difference between the 15 Rand 40 that they sell at and the 15 Rand 20 that they buy at. So the bank makes a profit of 20 cents. It's the difference between their buying and their selling rates. Then also linked to that, the mid rate is actually just the average of the buying and selling rates. So if we wanted to calculate the mid rate, it would be 15 Rand 40 plus 15 Rand 20, and we would divide that by 2 in order to calculate the mid rate. So our mid rate is going to be 15 Rand 30. We then need to understand what a cross rate is. Now, what's important, guys, is normally all currencies are quoted relative to the US dollar. So it's possible to calculate an exchange rate between any two currencies using this cross rate mechanism. Let me show you an example so that this makes a little bit more sense. Most currencies are quoted relative to the US dollar. So in this example, I've told you $1 US is equal to 15 Rand and 5 cents, and $1 US is also equal to 0.7 pounds. So both the Rand and the pound are quoted relative to the US dollar. It therefore makes sense that 15 Rand and 5 cents is equal to 0.7 pounds, because both of these are equal to $1. So we can make those equal. We are then able to work out the exchange rate between the pound and the Rand, because we now know the exchange between the two. So all we need to do, guys, if we want to know what 1 pound is, we need to divide this by 0.7, because that will give me the value of 1 pound. And if I divide this by 0.7, I must also divide this by 0.7. So that's just mathematical logic. That gives me 21 Rand 50. So that means the exchange rate between the pound and the Rand, 1 pound gives me 21 Rand 50. So all we're saying in this example is because most currencies are quoted relative to the US dollar, it's possible to use this information over here and solve for the exchange rate between the Rand and the pound. And that's what we've done right there. You then need to understand the difference between a spot rate and a forward rate. Guys, the spot rate is the rate at a specific given point in time. So the spot rate is the rate today. Whereas on the other hand, the forward rate is a rate that is determined today, but it is for settlement on a future date. So I'll know what the rate is today, but I'm not going to settle today. I'm going to settle at that amount at some point in the future. and the forward rate will either trade at a discount or a premium to the spot rate. Once again, let's look at an example, add some numbers so that this makes a little bit more sense. In this example, I've given you the spot rate. 1 pound is equal to 22.2798 rands. So that is my spot rate. That is my exchange rate today. I've also given you the forward rate for 90 days. So let's say, for example, guys, you bought a machine from overseas and you have to pay for the machine in 90 days' time. What you can do in order to protect yourself from movements in exchange rates is you can go to the bank and you can enter into a forward rate agreement. So this is referred to as an FEC, or a forward rate agreement, where you agree that you will pay a fixed amount at a point in the future. So 90 days from now, you can fix your exchange rate so that you are not exposed to any foreign currency risk. Because remember, if I buy the machine today, this is my exchange rate today. But if I only need to pay for the machine in 90 days' time, there's a risk that the exchange rates are going to change during that period and the machine is going to end up costing me more money. So what a lot of companies do is they say they don't want to be exposed to that risk. They don't want that uncertainty because we don't know what's going to happen with exchange rates. So they go to their bank and they fix the rate today. They say to the bank, if I want to fix the rate, what can I pay in 90 days? And the bank says to you, this is the rate that you can have for 90 days. So now there's no uncertainty. The company knows in 90 days, this is the exchange rate that they will be able to get. And then they can pay for that machine. Now, if we analyze this information in a little bit more detail, we can see from these rates that we've been given that the rand is expected to devalue, because we can see in the future, in 90 days' time, it's going to cost me more rands in order to buy 1 pound. Whereas now it costs me less rands in order to buy 1 pound. So based on the information that I've been given, the rand is expected to weaken, which means the rand is trading at a discount. Or if we look at it from the other perspective, it means that the pound is trading at a premium. Now, it's important that you are able to calculate this premium as a percentage. And for the purposes of this example, please assume that there are 360 days in a year. So if they do ask this in your exam, they will tell you how many days there are in the year, and you use that in your calculation. So for this example, we assume there are 360 days in the year. So if we want to calculate this premium, all we do is we calculate the difference between the spot rate today and the forward rate in 90 days' time. So just get the difference between the two. I take my forward rate and I subtract my spot rate today. We can then see the premium that the pound is trading at, or the discount that the rand is trading at. This shows me how much the rand is expected to devalue over the next 90 days, okay? Or how much the pound is going to strengthen over the next 90 days. It's the difference between these two rates. If we want to work this out as a percentage, we just need to divide by the spot rate today so that we can get that as a percentage. And then please note, guys, this is only for a period of 90 days. So this difference that we calculated over here is for a period of 90 days. We need to calculate the annualized premium. So what we need to do is, once we get this answer over here, we multiply by 360 over 90. Why am I multiplying by 360 over 90? I'm multiplying by what I want. I want the annual premium. So I'm trying to annualize it. And I'm dividing by what I've got. This difference that we calculated over here is not the difference over a period of a year. This is a difference in rates over a period of 90 days. So if I just do the calculation like that without multiplying it by 360 over 90, you are going to work out the premium over a period of 90 days. We don't want the premium over a period of 90 days. We want the annualized premium. So what we need to do is we need to multiply it by what we want. We want the annual premium, so we multiply it by 360 and we divide by what we've got. This difference over here is for 90 days. And you can then work out the annual premium. Now, the logic behind what we've calculated is this means over the period of a year, so this has been annualized. So over the period of a year, the pound is expected to appreciate by 3.88%. So over the period of a year, the pound will strengthen by 3.88% based on our calculation above. How do I know it's over the course of a year? Because I didn't just look at the difference over a period of 90 days, I annualized that difference so that I can see what the difference is over the period of a year. Alternatively, guys, instead of having to calculate this premium as a percentage, what they could ask you to do is they could give you the spot rate today, and then they can tell you that the pound is trading at a premium of 3.88%. And they can ask you to calculate the 90-day forward rate. So they just give you different information. Instead of giving you the spot rate and the forward rate and you need to calculate the premium, they now give you the spot rate and the premium and you need to calculate the forward rate. Simple calculation, if you understood the logic above, we just take our spot rate today. We know that the pound is trading at a premium of 3.88%. So we know we need to increase this by 3.88%. However, just be careful, guys. We also know that this is the change over the course of a year. Remember, the 3.88% was annualized. We're not trying to work out the forward rate in a year's time. We are trying to calculate the forward rate 90 days from now. So I need to multiply that by 90 over 360 so that I can get the forward rate in 90 days' time. If you don't multiply by 90 over 360, you're going to get the forward rate in a year's time because this is the annual amount that we calculated above. Okay, so it's very important that you do multiply by 90 over 360 so that you can get the forward rate in 90 days' time. Then alternatively, a different way that they could do this, but a much easier way, if they could tell you this is your spot rate today and the pound is trading at a premium of 0.2161. Then you're not working with a percentage. Now it's much easier. You are just going to take the spot rate today, you add the premium, and you can get your forward rate. All right. So the only thing you need to be careful of over here, guys, and that you need to be aware of, look at it logically. We can see that the forward rate requires more rands than the spot rate today, which means the rand is expected to weaken or the pound is expected to strengthen. The rand is trading at a discount. The pound is trading at a premium. If you want to work out that premium, make sure you always annualize it. So multiply it by 360 over 90 in this case, because the forward rate we were given was for 90 days. Alternatively, they can give you that premium and you can be expected to work out the forward rate. But once again, remember the premium is an annual premium, so you need to multiply it by 90 over 360 so that you can get the forward rate in 90 days' time. Or even easier, they just give you the premium in rand terms. So you just take the spot rate today, you add that premium, and you can get the forward rate in 90 days' time. We then need to cover two other methods that can be used in order to calculate your forward exchange rate. So on the previous page, we looked at a few calculations over here. If you're given the spot rate, how you can calculate the forward rate if you know that the rand is trading at a premium or a discount, etc. We are now going to look at two further ways that we can calculate forward rates. Either we can use interest rate parity or we can use purchasing power parity. Now the difference between the two, guys, with interest rate parity, we are saying that the difference between the spot rate today and the forward rate in the future is because of the difference in interest rates between countries. Alternatively, when we look at purchasing power parity, we are saying that the difference between the spot rate today and the forward rate in the future is because of the differences in inflation rates between the different countries. So let's first just look at interest rate parity. Now, interest rate parity is used for predicting forward exchange rates in the short term. So for a period of less than 1 year. If we are given the spot rate, so you can see in the example below, I've given you the spot rate today. And I've also told you that the interest rate in South Africa is 9% and the interest rate in the USA is 3.5%. If you are given that information, it is possible to predict the forward rate using that information, because interest rate parity says the difference between the spot rate, so this rate today, and my forward rate is because of the difference in the interest rates between the countries. And I have been given the different interest rates between the countries. So using this information, I can predict my forward rate. We also said that interest rate parity is used for predicting forward rates in the short term. So in this example, I'm trying to calculate the forward rate in 6 months' time. It's a short-term calculation. Now, please note, you must learn this formula. What we do is we take the spot rate today, we multiply by 1 plus the interest rate in your reference currency country, and we divide by 1 plus the interest rate in the base currency country. Now, guys, all that means in simple terms is here we are using the interest rates in South Africa, and here we are using the interest rates in the United States of America. So all we do according to this formula is we take that spot rate today, multiply by 1 plus the interest rate in South Africa. What is the interest rate in South Africa? 9%. What is the interest rate in the USA? 3.5%. Now, please be careful. These rates that you've been given, if you're given a rate, you always need to assume that it is an annual interest rate. So in South Africa, interest rates are 9% per annum, and in the USA, interest rates are 3.5% per annum. That is not the interest rate over a 6-month period, it's the annual interest rate. So be careful, we are not trying to calculate the forward rate in 1 year's time. If we were trying to calculate the forward rate in 1 year's time, that would be my calculation, because this is my annual interest rate. So that would give me the forward rate in a year's time. However, I'm trying to calculate the forward rate in 6 months' time, which means I need to take these annual interest rates that I've been given and I need to multiply by 180 over 360. So once again, in this example, I'm assuming that I've got 360 days in the year, and we are trying to calculate the 6-month forward rate. So if there's 360 days in the year, that means there's 30 days in each month. So 6 months is going to be 180 days. Obviously, guys, alternatively, instead of using days, you could have also just said here, multiplied by 6 over 12 and multiplied by 6 over 12, instead of multiplying by 180 over 360. Obviously, both will give you exactly the same answer. The logic is you just need to take this annual interest rate and you need to apportion it for a period of 6 months so that we can work out what our forward rate is in 6 months' time. So that is another way how we can calculate forward rates. If they give you the spot rate today and they give you the interest rates in the different countries, you can use that information in order to calculate an exchange rate or a forward exchange rate in the short term. Now, purchasing power parity works in exactly the same way. The only difference is we are not using interest rates, we are now using inflation rates. And this is used for predicting forward rates over the long term. So we use interest rates when we are trying to predict forward rates in the short term, and we use inflation rates when we are trying to predict forward rates in the long term. So look at the example below. Once again, you are given the spot rate today. So that is my exchange rate today. I know that my inflation rate in South Africa is 6% and my inflation rate in the USA is 3%. You can see the formula below is exactly the same as the formula we looked at with interest rate parity. However, the only thing that changes, instead of using interest rates, we are now using inflation rates. And remember, I said to you, this is just going to be the South African inflation rate, and this is going to be the inflation rate in the USA. Now, purchasing power parity is used to predict forward rates in the long term. So in this example, I want you to calculate the forward rate 2 years from now. We start with our spot rate, exactly the same logic that we looked at with interest rate parity. Start with your spot rate. Then we are going to multiply by 1 plus my inflation rate in South Africa. My inflation rate in South Africa is 6%. Divide by 1 plus the inflation rate in the USA. My inflation rate in the USA is 3%. Guys, if I was trying to calculate the forward rate a year from now, that would be my calculation. Because once again, these are annual inflation rates. However, we need to calculate the forward rate 2 years from now. So I must put both of these to the power of 2 so that I get the forward rate 2 years from now. If you want the forward rate 3 years from now, you then need to put that to the power of 3. Okay, and you can then calculate the forward rate in 2 years' time. So up until this point, please make sure you are happy with all of the different calculations that we've looked at in how you can take a spot rate and you can use the information given in the question in order to calculate your forward rate.